Unsettled US-Iran tensions are crimping oil supply. That pressure reaches your fuel bill, your grocery shelf, your heating costs. So here's the question that actually matters. When two countries can't make a deal, how does that squeeze oil out of the global system? And who ends up paying? The Reuters headline is blunt. Oil is on track for a second consecutive weekly rise, and the driver is an unsettled state of affairs between the United States and Iran. War risk concerns are crimping supply expectations. Markets don't need a bomb to drop. They need uncertainty, and right now, there's plenty of it. The deeper question isn't what happens next in those negotiations. It's how geopolitical tension translates into a price you pay at the pump. That mechanism is older than the news cycle, and it's worth understanding from the ground up. Oil is not like most goods. You can't easily substitute it, stockpile it cheaply, or reroute it overnight. The global oil market is a single, interconnected system, and a disruption in one corner ripples into every other corner. Iran is one of the world's significant oil producers. It sits on enormous reserves and has the infrastructure to export millions of barrels every day, when it's allowed to. Sanctions, conflict risk, and blocked shipping lanes can all reduce that flow. When supply expectations fall, even before a single barrel is actually withheld, traders and buyers start adjusting. They don't wait for the crisis to confirm itself. They price in the risk. That's the engine underneath the headline. And it runs on something most people haven't thought carefully about: the difference between actual supply and expected supply. In oil markets, expectation is reality. A threat to supply is already a supply cut in price terms before it becomes one in physical terms. That gap between what might happen and what has happened is where oil prices do most of their moving. Think about a town with one bakery. Every morning, people line up and the baker sells out by noon. One day, a rumor spreads that the baker might close for a week. What happens the next morning? People arrive earlier. They buy more than they need. Some buy for neighbors. The line gets longer, the shelves empty faster, and by 10 in the morning the bread is gone. Not because the baker actually closed, but because everyone believed they might. That's the oil market during a geopolitical scare. The baker in this story is a producing country. The rumor is the diplomatic breakdown. The early shoppers are refiners, traders, and national energy buyers, all trying to secure supply before the shelf empties. Now here's where it gets structural. The oil market has a concept called the risk premium. That's the extra cost baked into a barrel's price simply because the situation is dangerous or unpredictable. It's not a fee anyone charges deliberately. It emerges from thousands of buyers and sellers all adjusting their behavior at once, all responding to the same rumor about the bakery. When Iran and the United States are in open, productive talks, that risk premium is low. Buyers trust the shelf will be stocked. When talks break down, or war risk language enters the news, the premium rises. Buyers start arriving earlier. They pay more. And critically, the price rises even if not one extra barrel is lost. The physical disruption and the price disruption are two separate events. The price move usually comes first. That's why headlines about diplomacy move markets immediately. The mechanism isn't about what is happening to supply. It's about what buyers believe will happen, and how fast they act on that belief. So where does this land for you? Start at the fuel pump. When oil prices rise on geopolitical risk, refined fuel prices tend to follow. Gasoline, diesel, jet fuel. They all begin as crude oil. A rise in the underlying cost of that crude works its way down the supply chain and shows up in what you pay to fill a tank. But fuel isn't only something you burn in a car. It's something businesses burn to move goods. Trucks run on diesel. Ships run on fuel oil. Planes run on jet fuel. When those operating costs rise, businesses face a choice: absorb the hit or pass it on. Most pass it on. That's when a geopolitical standoff in the Middle East becomes a higher price tag on a shelf in a grocery store, a higher shipping surcharge on something you ordered online, or a higher heating bill when winter arrives. This is the chain. Diplomatic tension raises oil prices. Higher oil prices raise transport costs. Higher transport costs raise the price of almost everything that moves, which is almost everything. And here's what makes it particularly stubborn: the chain doesn't unwind the moment diplomacy resumes. Contracts have been signed. Fuel has already been bought at elevated prices. The premium lingers in the system even after the headline risk fades. In an environment where inflation is still a live concern, U.S. consumer prices were running at 3.3% year-over-year as of mid-2026. Any sustained push upward in energy costs is not an abstraction. It's a direct pressure on household budgets that were already stretched. Energy is not one item on the inflation list. It's a multiplier that runs through the entire list. So let's return to the question from the top. When two countries can't make a deal, how does that squeeze oil out of the global system? And who ends up paying? Here's the honest answer. The squeeze often happens before a drop of oil is actually withheld. The mechanism is expectation. Buyers anticipate disruption. They adjust behavior. The price rises, and the cost lands eventually on anyone who uses fuel directly or buys anything that had to be transported. The US-Iran standoff that Reuters flagged is one instance of a pattern that has repeated throughout the history of modern oil markets. Every time a major producing region enters a period of genuine uncertainty, the bakery rumor spreads and the early shoppers arrive. What this event illustrates is the structural vulnerability built into a global system that depends on a small number of critical suppliers, routes, and choke points. When any one of those is threatened, even just threatened, the whole system reprices. The geopolitical risk premium is not a glitch in the oil market. It's a feature. It's the market's way of saying, supply is not guaranteed, and guaranteed supply is worth paying for. The people who pay for that guarantee are not traders or governments. They are, in the end, ordinary people filling a tank, heating a home, or buying groceries that arrived on a diesel-powered truck. The deal that didn't get done in a diplomatic meeting isn't an abstraction. It's a line item. And now you know exactly how it gets there. If you found that useful, share it with someone who's wondering why their fuel bill keeps moving with the news. And if you want to understand the other mechanisms that quietly drive the prices in your life, subscribe. We publish one of these every week.